So you may say, well, penny stocks are risky, or blue chip stocks are not so risky. Well, I've got news for you. Every stock has risk, but you can make all of your trades have the same amount of risk using something very simple that I'll show you in this video. And then I'm going to analyze the markets. We'll figure out where they're likely to go. And finally, we're going to look at the swing trade of the week on VTGN. All right, so maybe you want to buy Microsoft, maybe you want to buy a penny stock. How can you make every stock have the same amount of risk? Well, the risk of a stock is often confused with the volatility of the stock. Penny stocks have much greater volatility in percentage terms. It's much easier for a 50-cent stock to go to $1 or down to 25 cents than, say, a $50 stock going to 100 or down to $25. And so the result then is, for the more volatile stocks, you're simply going to buy less of them. Now I'm going to walk you through a couple of examples where we do this. We're going to look at a 75-cent stock and contrast it with a $450 stock. And what you'll see is that the larger price stock, the more expensive stock, we end up buying more in dollar terms than we do of the much more volatile penny stock. And in doing so, we give every stock the same amount of risk. So here's how it works. You define the risk of the stock as the difference between your entry price and your stop loss price. And then you take your risk tolerance, how much you're willing to lose, and divide that by the risk of the stock. So let's go through some examples and make a little more sense. So the first example I want to show you here is a swing trade that I did on Canopy Growth today. So the entry price was right here at about 75 cents, and the stop loss price is about there at 69 cents. So that meant the entry was 75 and the risk was 69 cents, which was 0.06, basically 6 cents per share in risk. So for every $100 of risk that I want to take, I'm going to buy 1,650 shares, which has a cost of about $1,240. So $1,240 for every $100 of risk is what you have to put into that stock. Now let's look at a much more expensive example of a stock that was moving strong again today. This is Lululemon, and the entry price on this one is about $471, and the stop loss price about $463. That meant there was $8 a share in risk. Now again, if I want to take $100 of risk and I divide that by $8 a share in risk, I get 12 shares. It's actually 12 and a half, but we'll round it down to 12 shares. 12 shares times 471 is roughly $5,640. So the position size for the same amount of risk in Lululemon was about 3 or 4 times, more than 4 times actually, what it was on Canopy Growth. Two very different stocks. One's a large cap retailer with a price of $471 a share, and one is a cannabis company trading at 75 cents. But because the cannabis stock is much more volatile, you buy a lot less in dollar terms, and thus making both have the same amount of risk. All right, let's get into this week's market analysis. And we're going to jump into the Stockscores charts here. Here's a chart of the S&P 500. And you can see that it's been trending up on the daily. Let's take a look at the intraday chart. And it's generally been moving higher for the last month. Now looking at the 3-year weekly chart, you can see that we've had a good rally over the last 6 weeks. And we're coming into resistance at this price peak. So I think it's very likely that we'll see a little pullback in the S&P in the near term. There's no sign of one yet, so what you want to watch for is, if we look at this chart, for example, this is again the 60-minute chart going back 15 days, is watch to see if this upward trend line gets broken. So if we were to come into here and then break down through that, we're probably going to start a little pullback. Hasn't happened yet, but that's something I'll be watching for next week. What about the NASDAQ stocks? Let's take a look at the NASDAQ 100. And you can see that they've been going sideways for the last couple of weeks, but still in the short term, the trend is up, a little bit soft in the last couple of weeks, as I said. Looking at the 3-year weekly chart, unlike the S&P, this market has already broken through that resistance. And so it probably will get a little more upside until it hits the next level of resistance right around there. So a little better looking chart than the S&P, but not considerably so. Now, the US small cap stocks are playing catch up. They have underperformed the large caps. And you can see that the downward trend line was broken right here. We built a rising bottom and then broke out from that this week. So this market is nicely moving higher. The short-term trend is up and it has a lot more upside till it gets to resistance, unlike those large cap indexes, the NASDAQ and the S&P. If you look at the 1-month chart, it's been doing better over the last few weeks than the large cap stocks, where they've been going sideways. This market has been actually trending up, and that is because interest rates have been falling, and I'll look at that chart in just a moment. Well, let's jump to the Canadian market now, Toronto Stock Exchange, T.XIU. Let's look at the 1-month chart, generally going up, but a little soft in the last few weeks. And looking at the last year and a half, it's been stuck in this sideways range. So upside is somewhat limited because of where resistance is from all of these price peaks here. So it's a neutral market in the long term. Let's move to gold and oil, which have a big influence on the Canadian stock market. And here's the chart of gold. You can see we've been pulling back the last week, but we're simply coming back to the upward trend line. Now it's quite a bit more volatile. When we look at this 1-month, 2-hour chart, you can see the upward trend line was broken at the top of the week, and we've been drifting lower. It's still not a really negative chart, more neutral. Looking at the 3-year chart, you can see that we're kind of fighting with this resistance. We made a breakout last week and we've come right back down into it. So we're kind of stuck there, sort of neutral looking. What about oil? USO has been underperforming the market over the last couple of months. You can see the trend is down. If we look at the 1-month, 60-minute chart, trend is down, therefore it's bearish, something to avoid. The 3-year weekly chart is not terrible because we have good support here, but I think we're going to get there. I would expect the next couple of weeks we'll hit that support zone and then bounce, and that may be a buying opportunity when we get down there. Let's take a look at the US dollar. US dollar has been moving downward over the last 6 or 8 weeks, and I'll show why in a moment. It is not a terrible chart, the US dollar. It's kind of started to break that downward trend there. And on the 3-year time frame, it's really just stuck in this sort of sideways range that it's been in for most of this year. Sort of a wide range, albeit, but still sideways range. Now let's take a look at the bond market. TLT is the symbol. And you can see that the bond market has been moving up, which means interest rates have been moving down. If you want to see a way to capture the essence of interest rates, just go to TBT and look at a 1-month chart on TBT. And if this is moving down, that means interest rates are moving down. So if we go back to the TLT chart, trend is up. Had a little pullback on the jobs number on Friday, and we may pull back a little more, but generally the bond market is moving up over the last little while and is probably going to continue, which means the real interest rates, the ones that are found in the bond market, are getting lower. And that's a positive for stocks, and it's the reason the US dollar has been a bit weak. Let's take a look at Bitcoin, which has been one of the hot markets of the last few months. Good upward trend there. Getting a little extended. I think it's a hold. I wouldn't buy here, but it is strong. All right, so my ratings then. You can see them there. Bullish in the short term on all the stock markets, but mostly neutral in the long term. Slightly bullish on the NASDAQ. Gold neutral on both time frames. Oil and the US dollar bearish in the short term, neutral long term. Bitcoin remains bullish on both time frames. And interest rates bearish short term and neutral long term. All right, let's get into the trade of the week. We're going to go through that position size calculation again that I did at the top of the video. So this is a stock that I bought as a swing trade earlier in the week. using what I call my Alpha Echo strategy. It's something that you can learn in the Stockscores course on active trading. You can learn more about that at stockscores.com. There's the buy point, action candle, breaking a pullback. There's a few more rules to the strategy than that, but that's the basic idea. In this case, the entry point at about 387, support at 368. So let's call it 20 cents a share in risk. That means for $100 of risk, we're going to buy 500 shares. 500 times 20 cents is $100. If we wanted to take 1,000 shares of risk, or $1,000 of risk, then we would buy 5,000 shares. But for $100 of risk, it requires $1,935 in the position, but using margin, because the stock is over $3, you can margin it 3 to 1, meaning your actual dollar outlay on this trade is about $645. $645, and this trade went up to the sell signal right there for a 4-point times risk gain, or a $480 gain. That's a 74% return in about 4 days, a little better than 4 days. Okay, 1 day hold, no, 4 or 5 day hold. All right, so it's using that simple concept. Take your risk tolerance, divide it by the risk of the trade, which is the difference between your entry price and the stop loss price, and then size your position accordingly. Every stock ends up having the same amount of risk. Hope you've enjoyed this week's Stockscores Market Minutes video, and if so, click on that like button, subscribe to the channel. I want more people to view this, and the more people like it, the more people subscribe, the better it is. The more audience we have, the better the content we can create. All right, hope you've enjoyed it. Trade well.